Traders may want to put on their hard hats. That's because US markets picked up where Japan left off, and the global stock market.
The new year raises big questions for major economies around the world. What is the outlook for growth in 2025? With the breaking news, a fresh trade war between the US and China has just kicked off.
Tariffs 25% on Canada and 25% on Mexico, and that'll start.
For decades, U.S. Treasuries have been the bedrock of global finance, the so-called gold standard of safety in an uncertain world. Nations trusted American debt because it was considered risk-free, backed by the largest and most powerful economy on Earth. Holding U.S. bonds was a symbol of financial security and insurance policy for governments seeking stability in turbulent markets. But now something shocking is happening. 16 of America's closest allies, from Japan to the United Kingdom, are selling off U.S. Treasuries at an unprecedented rate. This isn't just a routine market fluctuation. This is a strategic shift that signals something far more ominous. Japan is slashing its holdings. Saudi Arabia is quietly pulling out. The United Kingdom is moving to diversify away from U.S. debt. These are not isolated incidents. The financial world is shifting beneath our feet. And at the center of it all lies a potential crisis, one that could change everything. Why now? Is the United States losing its grip as the world's financial safe haven? For most of modern history, U.S. government bonds were viewed as an unshakable foundation of financial stability. Nations held them because they were risk-free assets, a reliable way to store value while earning steady returns. But that trust is crumbling. A series of financial and political crises have shaken confidence in America's ability to manage its debt. The debt ceiling standoff, a recurring political spectacle, has repeatedly brought the nation to the brink of default. Investors are watching in disbelief, questioning Washington's ability to act responsibly. Inflation has soared to multi-decade highs, eroding the purchasing power of the dollar. The Federal Reserve's aggressive interest rate hikes meant to control inflation have only deepened concerns by increasing borrowing costs and slowing economic growth. Even America's most loyal allies are rethinking their positions. Japan, historically the largest foreign holder of U.S. bonds, has been forced to trim its holdings to stabilize its own struggling economy. The yen is weakening, domestic spending is rising, and Tokyo can no longer afford to carry the same level of U.S. Saudi Arabia, long tied to the dollar through the petrodollar system, is making bold moves. With shifting geopolitical alliances and growing partnerships with China and Russia, Riyadh is reconsidering its reliance on Washington. And the United Kingdom, grappling with post-Brexit economic realities, is strategically reallocating its reserves to hedge against an increasingly uncertain financial landscape. The message is loud and clear. These nations are no longer willing to put all their eggs in one basket, and that should concern everyone. For nearly 50 years, the dominance of the U.S. dollar has rested on a crucial foundation, the petrodollar system. In the 1970s, the U.S. struck a deal with Saudi Arabia. In exchange for military protection, Saudi oil would be priced exclusively in dollars. This forced the nation to hold vast reserves of U.S. currency just to buy energy, cementing the dollar's supremacy. But that foundation? It's starting to crack. Saudi Arabia has reportedly been in discussions to price oil in alternative currencies. And if that happens, the entire petrodollar system could begin to unravel. China and Russia, America's biggest geopolitical rivals, have been leading a global de-dollarization effort, urging trade partners to settle transactions in local currencies. The BRICS nations, Brazil, Russia, India, China, and South Africa, are actively exploring alternative reserve systems that could bypass the dollar entirely. If the petrodollar system collapses, the consequences for the United States would be catastrophic. Demand for dollars would plummet, making it harder for the government to finance its ever-growing debt. Inflation could spiral out of control as the dollar weakens. The U.S. economy could be on the brink of a financial crisis unlike anything we've ever seen before. The global sell-off of U.S. Treasuries isn't just a theoretical problem, it has immediate, real-world consequences. When major holders dump U.S. bonds, bond prices fall. And when bond prices fall, yields rise. Higher yields mean higher borrowing costs for the U.S. government, which is already drowning in an eye-watering $34 trillion of debt. This puts the Federal Reserve in a near-impossible position. To stabilize the situation, the U.S. might have to offer even higher interest rates. But that could trigger a deep recession, slowing economic growth and increasing unemployment. On the flip side, if the Fed doesn't act aggressively, the dollar could weaken further, fueling inflation and eroding the purchasing power of Americans. And the bigger, more unsettling question is this: is the U.S. losing its safe haven status? For decades, investors and central banks around the world viewed the U.S. dollar and treasuries as the ultimate refuge in times of uncertainty. But if confidence continues to erode, we could be witnessing the beginning of a global financial realignment, one where America is no longer the unquestioned epicenter of stability. As trust in the U.S. dollar weakens, countries are scrambling for alternatives. And for May, one asset stands above the rest: gold. China and Russia have been stockpiling gold reserves at unprecedented rates. Central banks worldwide are increasing their gold holdings, signaling a growing distrust in the dollar. But gold isn't the only option. Digital assets, once dismissed as speculative and unstable, are now being seriously considered as alternative stores of value. Meanwhile, China is aggressively pushing for wider adoption of its yuan in global trade, cutting deals with key partners to bypass the dollar entirely. Perhaps most concerning for the U.S., the rise of a parallel financial system. The BRICS nations are working on creating a multinational reserve currency designed to rival the dollar's supremacy. While still in its early stages, the very fact that major economies are taking steps to reduce their dependence on the U.S. is a massive warning sign. The financial world is evolving and America's dominance is no longer guaranteed. So, what happens next? Will Washington wake up and take decisive action, implementing economic reforms, strengthening alliances, and restoring confidence in the dollar? Or will it continue down the same path, clinging to its past dominance while the world moves on? If the U.S. fails to control its runaway debt and refuses to adapt to this shifting financial landscape, the consequences could be severe. The dollar's dominance could gradually erode, with global markets increasingly turning to alternative reserve assets. This won't happen overnight, but make no mistake, the trajectory is clear. Countries are hedging their bets, preparing for a future where the U.S. is no longer the undisputed financial superpower. One thing is certain: the world is watching, and the U.S. can no longer afford to be complacent. What do you think? Is the dollar's dominance slipping away? Let us know your thoughts in the comments. And don't forget to subscribe, turn on notifications, and stay tuned for more deep dives into the world of global economics.